Welcome to the Find My Catalyst podcast. We all have problems we're looking to solve, and we know that there are solutions out there, but we struggle with this. How do we find the solution? Where's that nudge come from to help us take the next step and start solving tough problems? This podcast is designed to help you find your catalyst and take that next step. I'm Mike Simmons. I am the founder of Catalyst Sale. This episode is brought to you by the Catalyst Sale Game Plan. It's our approach to goal setting and execution. If you head to catalystsale.com/game, you can find more information. My catalyst today is David Paul. David is the Managing Director of DWP Capital and a leader in the venture capital and growth equity space. David, it is awesome to meet you. I just recently came across your stuff, and I think it was through, I don't know if it was tied to travel that you did out to Miami, but there was some way that we connected up through LinkedIn. And here we are a little bit less than a week or so later, and we're recording an episode on the podcast, which is going to timestamp this, and this will go live a number of weeks from now. But it's good to meet you. It's good to see some really cool comic books in the background and go down memory lane in some of the comic books. You had said Batman when we first started talking to each other as a favorite. Why Batman?
I think I like Batman because if there was a superhero out there in the world, I think it would be a Batman-like type of vigilante. He's rich, he's brooding, he doesn't give a shit. So I just, that resonates with me. So, I'd like to think that there's a Batman out there.
Very cool. I'm sure there is. There's somebody out there who's got access to some really cool tech, who is doing some really cool things in the background, who's helping people solve some really interesting problems and keeping people in check, and doesn't really worry about being too forceful and getting it done, but still has standards and isn't going to go out and pick up a gun. He's going to use his fist and he's going to use other things.
I think that's Elon Musk, if anybody.
So I would think of him as more like Iron Man. I'm thinking, right. So he falls into more of the Tony Stark room area for me, but that's, so maybe it's a combination of Elon and
but do you know who the richest Marvel character is out of all of them?
Richest Marvel character out of all of them. I would either go like Reed Richards or I would go like Hank Pym, but I don't know. Those would be the two.
No, it's the Black Panther.
No kidding.
Yeah, because he sits on all the mimes of the vibrarium.
Very, very cool. Mm-hmm. See, complete miss. Miss.
Exactly. Never thought about it.
So let's talk. So you were out in Miami. What was Miami like in a couple of weeks ago as the world is starting to talk about financial meltdowns and challenges and money kind of moving back? What did you see in Miami?
So I actually lived in Miami out of college. So it was very nostalgic going back there. I haven't been back there in over 10 years. And the amount of infrastructure that's been built is absolutely incredible. The area that I went to college, which was like North Miami, was still kind of shitty. I kind of went back through the old bars and the old apartments to try to look at that. But the areas that are up and coming are definitely well developed. Miami was very famous during COVID because San Francisco completely broke apart and got destroyed. And I think it was Keith Raboy, the founder of, or the managing director of Founders Fund. He moved down there first and got together with the mayor, who I forgot his name, and just basically a bunch of VCs followed him, and it became this giant tailwind. And it's funny because nobody thought of Miami, like Phoenix was more of a tech hub than Miami was.
No kidding. Okay.
Yeah. So it came from zero to like super infiltrated by venture capital dollars through Twitter. It's unbelievable.
So let's talk a bit about your background and DWP Capital. So how did you get into capital? And then I want to get into some discussion around common misperceptions that people have around capital, different types of capital. How did you get into capital?
Sure. So I got into venture capital through a little bit of nepotism, actually.
Okay.
So, it's a very competitive kind of industry to get into within finance. There's a bunch of different avenues to get down there. I was very lucky. I've got a brother that is a private equity venture capital guy. He's a half brother. He's much older than me. And I sold my business in South Florida at the time. I was living in West Palm and I was looking for something to do. I was looking at doing some angel investing and, I could just tell South Florida was not the place to do angel investing. And I was kind of trying to pick his brain on, the next step in my career. And he said, you should go take a look at this venture fund in Arizona, and, go work there for free for 90 days and, see if you like it and take a look at these kind of, emerging growth companies in these undercapitalized markets. So I moved to Arizona. I worked for a firm which is no longer around called Tallwave Capital. And I ended up being there for, 2 weeks before I decided that I wanted to stay here. Right. So I sold my house and I, essentially interned there, was an analyst from, for about a year and a half. And then I was recruited to another firm called Canal Partners.
Is it Ed with a B?
Borromeo. Yeah. So Tallwave has an interesting history. So they, initially there was two branches kind of it. There was like a startup studio, venture studio, and then there was a capital side. And the original business model was the capital side was going to fund a bunch of companies going through the startup studio.
Yep.
Turned out the LPs really didn't like that, because it was just funding the payroll of the startup studio. So they wanted their own dedicated portfolio, right? And that's where they kind of brought me and this other guy in from Utah to help on the capital side while the startup studio tried to, generate their own P&L. And then, over time, I think now they work with bigger enterprises and kind of does corporate innovation.
So let's talk, you said limited partner, general partner. Let's talk about the different types of partnerships that exist inside these funds, because there were some people who are new to capital, who are new to different types of capital as they're listening. So what's the difference between a GP and an LP?
Sure. So, and this was structurally done because of the law, right? On how capital comes together or capital formation, how it comes together in an organized way in order that it is deployed in an organized way. And I think I just read the book Power Law, so I'm going to sound a lot smarter than I normally would be, but
awesome.
So generally there's this investment structure called a limited partnership where there's, general partners and limited partners. General partners are generally the managers of the fund, people that are making the investment decisions, running the diligence, sitting on boards after investment to try to, increase enterprise value and see the companies to the next inflection point of growth. And then there's limited partners who essentially put in capital and don't have those managerial perspectives. And there's the GPs and the LPs both put in capital. The LP capital commitments are generally much more than the GP capital commitments because there's only 3 or 4 general partners, and there could be upwards of, I think, a maximum of 100 limited partners.
Oh wow! Okay.
Yeah, and then they charge the limited partners a management fee and carried interest, which is like 20% of all the profits. But generally, you're going into the relationship as a partner, but some of the partners have managing rights, and some of the partners just have financial benefits.
So managing rights, meaning that they can
they're making the investment decisions.
Got it. Okay. And then do LPs do they start to provide deal flow? Is that another reason to have LPs inside there? Is that part of the equation as well?
Yeah. I think if you have a really good limited partner base, it's a great source for deal flow. There's a fund called Stage 2 Capital, and I think they're up in Boston, but they were, a bunch of the HubSpot CRO guys. Yep. And, there's a bunch of, marketing and sales executives that started this fund as GPs, but all their LPs are sales and marketing, executives, right? Or founders. And, they get a ton of deal flow through their LP network.
Yeah, it's pretty interesting to see that. There are a lot of these operator funds that are popping up. GTM fund is one of them, is Stage 2. There are a number of these that are starting to pop up. And in Phoenix, one of the bigger ones is a founder fund. So you'd have these founder funds that pop up out there. So it seems like as funds come together, there's a collection of people who have a common experience or common something that come together to look at different ways to deploy capital. Is that fair?
Yeah. And I think honestly, it's more of a tool to get LPs more interested in the fund as much as a necessity, to be quite candid with you. Yeah. Because an LP can put money anywhere. They can put money in real estate deals. They can put money in private equity deals. They can put it in the stock market. It's a very competitive, place, right? And venture funds. And generally, if you're investing from one single fund or one from high net worth person or one family office, you're probably an emerging manager. You're sub $100 million of assets under management, and you need to ask for capital But generally, people just don't want to be a check. They want to feel like they're important and that they're adding value. And, that's often part of the game, is making them feel like they're part of the club.
So let's talk about different types of capital. And I'm a novice when it comes to this stuff. I mean, I hear things like angel, I hear venture, I hear private equity, and I'm sure there are others out there who now will start to see things see things cluster. But what's the difference between venture capital and private equity?
Yeah, so there's actually one in between those two, which is called growth equity. Right? Okay. So and they all kind of get merged together, and they all but based on who they're talking to, they change their title. Right?
That's awesome. That's a little confusing.
Yeah, like who do you want me to be? I'll be whatever you want. Right? Just take my money.
Chameleon capital.
Yeah, exactly. So generally speaking, when you're talking about the different types of capital providers in what the proverbial capital stack, the first really differentiator from a high level is to look at really what is their investment strategy and what's their return profile.
Okay.
Right. So venture capitalists, quote unquote, venture capitalists are, company or funds that really have to have, they call that power law distribution where, every deal has to be able to return the fund, be like a 10x plus in order to offset all of the losers. And venture capitalists start from seed stage all the way to, E, B, C, D, E, F, G, all the way up there. And generally, those are high risk, high reward, big markets, boil the ocean type of strategies. When you look at growth equity, and then venture capital is usually also minority positions, which is also really important to differentiate, is that they are taking a minority stake. They do not, want to take control of the company. They want to enable founders to kind of go through. Now, the more, capital you take in, the more founder gets diluted. Eventually the founder does lose control, but that's not the VC is not trying to do that by design.
Okay.
Growth equity is similar to venture capital in the fact that it, generally is some type of minority stake, right? But the return profile is much less. So it's usually 3 to 7x in 3 to 7 years, right? Is what they look on to underwrite these deals for. Mm-hmm. Now, the difference is they want they have a lower return profile for each deal, but they also expect no misses. Right. So they generally have a much less burn tolerance. They really like companies that have, really good, unit economics, profitability on a gross margin basis and good revenue retention. And they're not burning capital to burn capital. So that money is used for growth. So both of those money's going on the balance sheet.
So in that instance, what stage will a growth, if we go through like the A, B, C?
Mm-hmm. Yeah. So you usually see growth guys coming in at the B level.
At the B level? Okay.
Yeah. Mm-hmm.
And then
private. Yeah. And then so private equity generally is people are buying the stock from the initial shareholders. It's not really capital that's going on the balance sheet.
Yep.
Right. So they're transacting, they're buying majority control. That's important to them. Usually companies have much more scale than that. These are guys that usually like to financially engineer growth. So they have inorganic growth strategies, and they generally buy these companies with debt as well. Right. So part of their business model is that over time, if they bet into a company that is in an emerging market that's growing, they can pay off the debt year over year and increasing enterprise value that way, because the cost of capital is much less on the debt side.
When you had said enterprise value, how should people think about enterprise value? What's a good definition for enterprise value?
Yeah, so the real finance term is like it's the amount of the stock price, like minus debt or minus the debt, add the cash. I think it's a formula like that. Okay. But it's essentially what the stock price is of the company, and then you add and subtract the debt on it, and then add the cash or something. So there's a little wonkiness, but it's essentially the value of the business.
So that's cool. It's good to hear you say that there's actually a definition for it. So the definition is not a definition that a group of people inside the organization make up to say, no, this is how we're going to provide enterprise value. It's not eyeballs out of sight or number of conversions that we're getting in a PLG, product-led growth model or something like that. It's actually, there's a financial definition for enterprise value.
Right. It's what people are going to pay for your stock.
Got it. Okay. Mm-hmm. So when you were talking through about on the balance sheet versus not on the balance sheet, what does that mean?
So what that means is there's two ways to find, that money comes into the company.
Okay.
Now, either comes in as dilutive capital, where the company issues more shares in exchange for cash, right?
Yep.
The other way is that I come in and instead of putting money into the balance sheet for the company to grow, I'm buying stock off an additional shareholder. So it's not dilutive, but it's like a swap. Yep. I'm buying shares from you and you're taking it from me. And now I own, more of the company.
Got it. Okay. So why do organizations start to, let's say I'm a startup who's generating a decent amount of revenue. I may have once you go down the venture route, does that mean you're staying on that path the entire time? Or do you see do those companies potentially get to a point where they end up being acquired by private equity, or investment from private equity comes in? So let's say they skip growth or skip that piece, but they shift the type of funding source instead of going B, C, D, E. Is that something that happens?
Yeah. So that's a really good question because, I would say 15 years ago, the only way to get liquidity if you were a founder or an employee is that you either IPO'd or there was a strategic acquisition of your company.
Okay. Yep.
Now with the convergence of all this capital that's sloshing around in the market, there are secondary opportunities, right? Where people are buying your stock. So, and then there's these hybrid models that we didn't talk about, which is, like we're doing a deal right now with one of our portfolio companies where they're buying $35 million worth of stock within the company, right? Yep. And they're putting $10 million on the balance sheet. So it's and they're taking a buyout. So it's a private equity like deal, but they're putting growth capital in as well and still expect to grow it.
So the benefit to the founder on that, or the founding team, or whomever is inside the business, is they actually get to extract some cash.
Exactly. Right. So they sell on the way up, right? Yeah. And then they can get rid of some investors that have been there for a while and, basically kind of clean up the cap table.
So why do you want to clean up the cap table?
Because every person that's on the cap table has a vote. And, you don't want people holding up the process of situations. I mean, there's always things in the documents where if a majority of the shareholders want, you can drag people along. Okay. But it's a risk perspective. You just don't want a bunch of people that might be litigious down the road and, want to sue the company for misdealings or something.
So why would a company how do you go through the process as a founder figuring out, do I want to take on money from somebody, or do I want to continue to bootstrap and self-fund and work things out? Maybe the bootstrapping happened through some friends and family investment early on.
Right.
You're not actually going
professional investor.
Yeah. So why might someone choose either of those routes?
Yeah. So that's a really good question as well. People usually depending on the type of company it is, generally people take funding because they see an opportunity to grow faster within an organization and to take market share.
Yep.
It also allows them to pay themselves more, right? And, actually have a well-capitalized business to go. The flip side of that is that, you're not just serving yourself, right? You actually have somebody else in bed with you, right? And you can't take that back, right? Once you fund the company. Actually, you can, but it's very difficult. I might be the only person in Arizona that's been able to do that, but
So what do you mean? So you got into a situation where you took on funding, and then did you just buy out the investors? Like
No. So I funded a company that was, doing okay, went flat. We had to put more money in the company, but in order to continue to grow. Yep. Right. And the founder literally was just like, if we put more money in the company, you're going to take control of the company. You could sell it. This is the only thing I have. Right. And, I'm much more, empathetic than most of people in my business. Uh-huh. So what we did is we structured a deal. It was mostly my money. And, I had a couple guys, investors in it, and we were able to, the company was still profitable. It had cash on the balance sheet, but we were able to redeem the stock of my outside investors. And then he pays me back on a monthly basis over the next 5 years, which is a good outcome for everything. I don't look like a monster and, right. And then my investors got their money out, and it actually came out to be a really good scenario.
Yeah. So what's the responsibility to investors? Like when an investor Or is there a responsibility to the investors? Well, actually, let me ask you the first one. What's the responsibility to investors?
Yeah. So my responsibility to my investors is I told them that there's a return here, right? And I need to make sure that the CEO doesn't blow it, right? I mean, there's always a level of failure that happens with early stage companies, and that's inevitable. But, I mean, I represent not just myself, but pools of capital, right? So generally speaking, when I do deals, I usually request a board seat. Right. I do budget approvals, right? I make sure that, the CEO just can't all of a sudden raise his salary to, an exorbitant amount and just drain profits out of the business. I need to make sure the company I can get the money out, right? And that, everyone's interests are aligned going forward. I mean, I think that's the biggest problem with a lot of deals that get done. And like what happens with founder and VC contention is that they really never got fully aligned before they did the deal.
Do they understand what alignment means?
No.
Okay.
No.
So,
you're going to fund my company. How much, but really what is your expectation? Like, what do you want, with this money, and what can you deliver? And, oftentimes people miss, and that's fine. You know what I mean? But like going from, I want to grow a company to, hey, I'm scared, to keep growing the company. I mean, that's a misalignment, right? Fundamentally, right? And so, I mean, that was my bad on that one, is that I really needed to drill down to this guy because he wasn't a super polished CEO. He didn't really understand. I mean, I just saw this great deal and I wanted to go into it. And he didn't really understood well, what happens if this goes flat, right? You know what I mean? What happens if we need to invest more? And not being able to, you making this a lifestyle business. I mean, that's not what we signed up for, right? Oh. And so we had to come to an agreement, and, I mean, thank God it was amicable, right? Because I've been in situations when that stuff is not amicable, and it's not a good look.
Well, and think about it. We're talking about things that are emotional and quantifiable. Right?
Totally.
So we're dealing with money that you can see. We're dealing with emotion relative to growing, the emotion of, hey, this is
ownership,
ownership, right. All of this stuff. So, wow, those has got to be, I would imagine. So how do you avoid the contentious conversations? How can we do better at this in helping founders, business leaders, and investors communicate better with each other so that we maintain this level of alignment?
Yeah. So I think for me, it's been, how I've gotten better at this over time is by making the mistakes. And, being emotionally intelligent enough to be like, hey, this doesn't sit right with me. How can we let's have a reset here, and let's talk about what you want, what we want, and go, and let's recalibrate. Now, what I'm talking to you about, that scenario that I just described to you of it not working and me getting capital out, that's pretty rare, right? I mean, generally, most founders know the game they're playing. They just don't change their mind halfway through, right? So, that is kind of the exception, not the rule.
So how do founders balance this is what I'm seeing in the market and this is what customers are buying versus this is what investors want to invest in?
Yeah.
And is that a tension that you see inside in the market?
100%. Right. Because, eventually, a founder will go out and start fundraising on what he or she wants the product roadmap to be. And then the VC goes, that market size isn't that big, right? And so they might hear that from a couple of people, and then they start, talking about a bigger story, right? They might be talking about a fintech play, right, within, the SaaS product and this giant vision. Then all of a sudden, because in what you're doing right now is you're optimizing your company for valuation because of market size, and you're kind of letting your capital stack dictate your product roadmap.
You mean you don't have a Web3 strategy as part of the growth of your organization right now?
Yeah, exactly. Yeah. I mean, this is really only a $600 million business. I need to be at least $1 billion. So, I mean, I'm literally I've made tons of money in companies that are less than $150 million in total addressable market, so I'm not one of those players. I literally, I shoot, how we talked about, venture, growth equity, and private equity.
Right.
I consider myself early growth equity.
Yeah.
Right. So, I play in the seed series A from a revenue and, team member and, product adoption perspective, but sure. I shoot for 3 to 5X in 3 to 5 years, and let's not get a 0.
So in the one of the things that you hear about there and out there, and I don't know if this is a misinterpretation on my end, but that if it's 1 out of 10 needs to return the fund, is that common? Is it 1 out of 10 organizations is what will return on the fund? Does that mean that 9 out of 10 investments might fail? How does that math play out when thinking about spreading money around the table and the various investments that are out there?
Yeah. So the 10 is just an example. I mean, some seed funds, there's a portfolio of 30, right? If you're a SoftBank, it might be 150 portfolio and it's a spray and pray type model. But, from the 1 in 10, let's just say that that's representative of an entire portfolio. Usually it's a third, a third, a third. They say, 3 out of the 10 or a third out of the 10 would be like a 7x plus. Third of the 10, is, 1 times to 3 times the money. And then the bottom third is zeros.
Got it. So it's not literally a 1 wins, 9 lose. It's there's a spectrum of winners and losers or level of winning and losing.
Correct.
Throughout that group.
Yeah. And usually like the miss rate goes, and now if you're like a pre-seed fund or like a super early fund that's in San Francisco, most of your usually there's 1 or 2 deals that make up the entirety.
So let's talk about the difference between San Francisco and Phoenix. It seems like more money is coming into Phoenix. Money is coming into the Valley. There's more attention. There's more excitement in the Valley. Why is that happening? One, is it true? Is there more excitement? Is there a vibe that's happening out here where more money is coming in?
I mean, I think that just to be a little bit more skeptical and start, cynical, I think more money is leaving the Valley. I don't think they're like, holy shit, this is a great market. You know what I mean? Like, I think it's a function of like just people being remote working and are looking for bargains and are kind of coming out and having more of a national type of investing strategy.
That scares the shit out of me because I'm thinking that more money is coming in, which gets me more excited about things that are happening. And
no, there is more money coming in. That's not a lie, but I don't think that it's a function of like, people are like saying like, oh my God, there's all this great talent here. You know what I mean? I think it's a function of just money's moving out of the Valley and it's going to like the top cities.
Yep. So what does the pool look like here in the Valley? And do you invest both in and outside of the Valley, or do you look to what's your thesis? Do you tend to stay more focused here?
So my thesis is to invest in B2B software companies, kind of late seed, early series A in undercapitalized markets. My deal sourcing strategy, there's only so many relationships that you can have. So I'm focused on 3 geographic markets, Phoenix being one of them. The other one is San Diego. And then the third one is Dallas. That being said, however, from an inbound perspective, right, if we see deals that, are in Kansas or Florida or North Carolina or whatever, and they meet our investment thesis and we're super excited about it, we'll do it.
We got to get Greg to do a Greg's List San Diego because I know he's got Phoenix covered and he's got Dallas out there and a number of other cities.
I think he might actually be working on San Diego now.
Good. Yeah. He was on the podcast a couple, by the time this goes live, it'll be a couple of weeks ago.
Yeah. Greg likes the microphone. So
he does. And he's really getting active on posting on LinkedIn. He's put some really good stuff out there poking. It's interesting to see all of the poking that happens as people start to look at different ways that you can fund an organization. You can fund the dream that you're building. One way to fund is, I just happen to be rich. I've got access to a lot of money and I'm going to go ahead and, put family money at it. That's one option. Not a lot of folks have that. I don't know, but that's one option. Or I did really well. Cul-de-sac, I think, is one that's big out here in the Valley. What group were the founders part of? They had an exit. It's one of the big, right? Are you familiar with Cul-de-sac?
I am. It's kind of like a new age prop tech company, right?
Yep. So they had an exit, and then I think that's helped with some of the funding. But you could self-fund. You can go out and bring on customers and have customers fund, or you can go out and bring on investors that have investors fund, or look at a combination of the 3, I would imagine. Mm-hmm. Why would I choose to go one way or the other? And I know we kind of got into the whole idea of speed when looking at venture, but how should founders be thinking about the different funding sources that even go beyond investment?
Yeah. And, honestly, some founders, they've raised money because they're lazy. You know what I mean?
What do you mean? So what are they lazy about? Like what?
I mean, because it's harder to fund your company with customers, right? I mean, like if you raise money, you can pay yourself 150 grand and, and play startup for a couple of years. That's the truth.
Why do founders struggle with the sales side of things?
I don't know. You know what I mean? Like, it could be an execution issue. It could just be a level of, it could be a market issue. It could be a product issue. That's the thing. Everyone's got a thesis for why a company's not growing, right? And everyone says it's a lack of capital, right? And I often think that that's literally the last thing. It's usually a product issue, a market issue, or a founder issue.
And what's fascinating, depending on which hammer you hold, the nail that you describe is going to be different. There's this bias around whatever. At least that's what I've seen in my experience.
Yeah. Well, it's so fun. Oh, yeah. No, we'll see it. The founder's like, oh, we just built out this platform. Now we're ready to scale. I'm like, how do you know you're ready to scale? You don't have fucking customers.
When's the last time you actually talked to a customer? And by the way, do you actually use the platform?
Right. Exactly. Like, do you dog food it yourself? Right.
What problem? And it's funny when you go through some of these stories, because what was it? Slack started as inside a gaming organization as a communication tool, if I remember the story right. But so there are these ways where products get founded out of something different. It is really hard to do something like that if you're so acutely focused on whatever the thing was that you started, which is, hey, I know that there's this problem out there. I've got this amazing hammer. Now I need to just go out there and find a bunch of nails, rather than going out there and saying, hey, wait a second, there's a lot of nails out here that could use.
Right. Well, dude, and listen, I've got the most amount. This is why I'm not a founder. If I was a good founder, CEO, I'd be one, right? I mean, the amount of energy and, pain and suffering that accompanies product market fit is second to none. I mean, utmost respect. I think, and I could be wrong about this, that finding product market fit is probably harder than company building, because you can hire people that have done it before to help you company build. Nobody's going to help you find product market fit.
Yeah.
That lies on you.
Yeah. And if you're looking for product market fit in the investor community, you're looking in the wrong place, unless you're just going to continue to go down the funding route, which I think that's one of the dangers that's out there on the investment side. It's
there's always a story, right? I mean, we needed to build the platform. Okay, well, we found a bunch of customers. Now we found the right customer, right? Okay, well, how do you know that that's the right customer? And then it just becomes this kind of never-ending dance of funding. And companies are just getting, or they were. I mean, I don't think anymore. I don't know if this is an evergreen show or not, but that the markets are not super friendly right now.
So let's talk a little bit about that. So it is evergreen. I mean, these things will sit out there forever. And so at some point in time, people are going to be like, why the heck were you talking about people wearing masks on airplanes? And then we go back into the whole I'm Batman thing. But So let's talk about what's happening in the market and how much of it is just fear mongering, how much of it is something else, how much of it's real, how much of this is just cyclical? What's your view on what's happening in the market today? And just from a time perspective, we're recording this in the middle of May 20th of 2022.
So venture capital is very cyclical, right? I mean, it's the most cyclical asset class probably out there. And I was lucky enough to be at a conference in Miami where the OG of investing, Bill Gurley, who has been in 3 or 4 market cycles, he described, venture capital market investing and the cycle. And he says, generally people go on risk with growth companies and investing slowly over a 10-year period. But then when they go off risk for one reason or the other, war, macro problems, interest rates rising, all of the above, you go off risk super fast. And that once liquidity is completely dried up, right? And we're seeing that right now in the public market, specifically in the growth stocks. And so the problem is that, as we talked about the capital stack, right? Yep. People putting more and more capital onto the business, your valuation goes up, 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 and up. And, there's this bridge, this chasm that you cross from late stage venture into being an IPO.
Okay.
And the goal is that you have an up round. And if you don't have an up round, if the public market, not just the VCs and the managers, but the market, the hedge funds, the A buying and selling, a truly efficient public market might not think you're as valuable as you think you are, right? And because there's another company that does what you do, but they do it better and they're cheaper than you and they're already listed, right? And so there's going to be a giant correction. So generally that puts a shockwave through the private markets. Now, generally there's a time lag because public markets are much more efficient and they move with much more bigger volatility, and it takes a longer time for the the private markets to correct as well. But we're seeing it now, late stage venture, like the guys that were like the crossover guys, the Tigers, the SoftBanks, they're either getting out of venture completely and or like returning capital. And now like what I'm seeing in early stage is that deals are taking much longer to get done. A lot of times term sheets are now getting pulled, right? I pulled a term sheet recently, not that I didn't like the company, but I just didn't like, if we are going into a recessionary environment, I don't like the customers they were serving because I didn't think that their retention was going to, stay the same.
I think if there's something to highlight in the conversation, there are similarities that you see here where you talk about pulling term sheets. You're actually seeing it on the employee side, where employees or people who've decided to leave companies to join another company are now seeing offer letters rescinded before they join on. So there's this knock-on effect that happens inside the market and across all organizations. How long do these cycles tend to last when you're, and I'm not that you've got a crystal ball and looks, except that Batman has access to a bunch of data and interesting stuff, but how do you start to look at these cycles? And then what are some of the indicators that start to demonstrate that, hey, we're starting to come out of this, or we're going to things are starting to move forward? What would you look at there? One, length of cycle, and then indicators to start to keep an eye out.
The stock market's a leading indicator, right? That stuff happens first. And then you start seeing like GDP data and, a lot of the employment reports, et cetera, kind of like, consumer credit. That's how you kind of see. I mean, the definition of a recession is to have 2 consecutive quarters of constricting GDP, right? And if I was a betting man, I'm going to say we've already had one, right? That we're going to have another. Now, there's a flip side and a counterpoint saying, okay, well, we also had ridiculously high GDP based on COVID pull through, right? And, maybe it's just leveling back off. That was an artificial amount based on the amount of capital, right? And, and maybe we're having a lower GDP because our supply chain sucks right now and we can't actually get goods and services out the door because we don't have the supplies to do it, right? Counterfactual, right? You have to look at both sets of data to actually make a decision. But I think we're kind of going into a recession. I think we're grossly over levered, and we need to start kind of pulling back turning off the money printer. Generally speaking, historically, bear markets from the high to going back up to the previous high generally is 18 months to 2 years, right? And of course, it's happened in 6 months. It's happened in 9 months. So that's not, at the end of the day, it's not, it doesn't seem like a very long time, but if you're a holder of wealth in the market, that's a pretty big foot on your head, right? For 2 years to have to live with. And you're not spending money, right? Because you're pucker butt, right? You don't want to, invest. You're in scarcity mode. You're not in abundance mode. That being said, however, the 2 year mark, that's historically what it's been. We haven't historically ever had this much stimulus in the economy before. Our debt has never been this big before, right? So, I wouldn't be surprised if it lasts longer than 2 years, right? Not saying that I think it's going to, right? But we don't have any toolkits to anymore. Like our interest rates, we can't lower them again. You know what I mean? Like we can't print money again, right? So I'm holding on. I'm sitting, I'm still looking at deals. I'm still very opportunistic. I think it's a really great time to invest in technology companies. I just think you have to be very selective.
Yeah. This is where being able to identify customers and being able to generate revenue inside a customer base because you're actually solving an important problem that customers care about. Not solving all of the problems, solving the problem becomes really, really powerful because it can start to extend out that runway for you. You start to bring in the cash. You start to get into that mode of self-funding. And that's why I'm excited that people will get back to more fundamentals when it comes to doing things like generating revenue or being deliberate about how you're growing business or how you're approaching the market.
Yeah.
What do
you're going to see a lot of shitty companies die, right? In the next, I think 12 to 18 months.
Yeah. David, awesome conversation. One of the things that you had posted recently is off the back of the Y Combinator, note that was shared. and it seems like it's made its way all the way through LinkedIn and Twitter and every place else. You highlight discipline in here around being price discipline. What does discipline mean to you, both from an investor perspective and how people should think about it when they're running their companies, from a founder perspective, and then individuals who are inside those organizations? How do you think about discipline?
Yeah, no, good question. The SaaS business model is the best business model on the planet. You're dealing with 80 to 90% gross margins, and ideally you're going to have 100% net retention if you have a good product. I mean, I don't know of a business that does better than that, right? And you get a recurring revenue compounding business. So understanding that if that is your goal and that is the business model, you can only burn $1 once, right? So if you only have X amount of dollars to spend, how can you make that revenue base be big enough to make you more valuable in the future, right? So that means like really thinking critically about your engineering. What products and features are you building? Is it going to add enterprise value? How do you know it's going to add enterprise value? What signal do you have from your customers? How do you know that it's going to take 6 engineers instead of 4 engineers? Have you really peeled that onion back, right? Do you really know what the utilization of your development team is? Do you really understand your close rate and understand the pitch that you're going to? Are you acquiring customers and losing them because, you're not on the calls, right? So there's no shortcut to this, right? There's no shortcut to any of this. And there's no shortcut to product market fit. There's no shortcut to go-to-market fit. And it just requires a ton of work. But if this was easy, everybody would be a billionaire.
Get back to the fundamentals and meet with customers, gather information, evaluate the data. One of the things that just a number that concerns me that you shared is you said 80 to 90% margin. That'll changes over time, right? Because the cost of retaining a customer ends up lowering over a period of time. I've seen founders early stage look at expecting that kind of margin right out of the gate. But that if you're bringing on a sales team to start selling, the new customer acquisition side of things is going to skew that data a bit. Realize that's an investment. And then, if you're doing it right inside the right customers, you're retaining those customers and growing those customers, then you start to see those numbers. Is that fair?
Yeah, that's a completely fair. I mean, generally, the customer success person might also be the salesperson. Salaries are getting split in many different areas of the profit and loss. So having really good SaaS metrics is really by the way of the series A, right? When you have 2+ million of revenue or more. If you're in that seed, I think it's really about positive customer references, to your point, net retention, and how many founder-led sales can you book?
David, awesome conversation. Where can people find out more about what you're working on?
Yeah, no, absolutely. So I've got a Substack that I do almost daily. It's called Ramblings, because really that's all it is ramblings in my head the first thing in the morning. And that's davidpaul.substack.com. And I've got a podcast, an interview podcast called The Capital Stack, where I interview operators, founders, and investors about all things value creation within startups. And I'm on all the platforms. You can look up The Capital Stack or David Paul, and you should be able to find it.
Awesome. We'll include links in the show notes. If you know somebody who would value this conversation, find it interesting, share it with them. Let David and I know both via LinkedIn, Twitter, however you share it. We like to see those shares out there. Sales is a thinking process. Business is a thinking process. Life is a thinking process. How are you thinking differently about your process?